Hi there, I'm Dara McDermott bringing you this update on the Irish economy. So last week we found out that the Irish economy returned to growth in the second quarter after a 9-month contraction. I have Philip O'Sullivan from Investec in Dublin on the line. So Philip, despite the positive data, the economy remains fragile. So what are your views on this, and of course, what are you expecting to see from Michael Noonan's budget?
Yeah, I suppose last week we would have saw that the economy expanded by 0.4% in the second quarter of this year. Now, that was driven by an improvement in private consumption and also in exports, which had a very weak start to the year. The reason for that was that our last budget was in December, so people would have noticed the impact of that on their disposable income in January and February, and obviously that would have dampened consumer spending. And we also had some pretty bad weather. And then on the export side, we had a number of patent expiries in the very large multinational pharmaceutical sector that's based in Ireland. So that kind of really gave us a very weak start to 2013, but some of that effect has kind of unwound as the year has gone on, and we've seen a stronger start to the second half of the year. To the second part of your question, just in terms of the budget, I suppose our sense really is that the government should stick to Plan A and implement the sort of austerity measures that they've been talking about doing for some years now, which is the famous 3.1 billion of adjustments. But there's obviously a lot of talk that some of the members of the government would like to see an easing of that, and I think over the next couple of weeks we're going to be seeing a lot of headlines ahead of Budget Day, which is on the 15th of October.
And over the weekend, Moodys raised its outlook on Ireland's debt rating to stable. Now, this potentially opens Ireland's debt market next year to investors currently restricted from buying bonds. So can you tell me more about this, Philip?
Indeed. Well, we've been seeing a lot of positive moves by the ratings agencies over the past year. Back in November, Fitch moved its outlook to stable from negative, and then S&P has actually twice upgraded its outlook in Ireland in this calendar year. So Moody's was kind of the only one of the ratings agencies that had Ireland on a negative outlook and a sub-investment grade rating. And after last weekend, look, I mean, we're still on a sub-investment grade rating from them, but they have moved from negative to stable. So I think the next step that we would expect to see from Moody's is an upgrade to put us back into investment grade, which would obviously widen the investor base that can invest in Irish government bonds. We're aware that a lot of institutions, particularly Southeast Asian funds, are unable to invest in Irish government bonds as much as they would like to, just given that the credit rating from Moody's is below the minimum that they can invest in. So we would expect, just given the progress that Ireland has been making, to see Moody's, become more aligned with the other big ratings agencies and upgrade at some stage over the next year. It'll probably be more of a 2014 event than something we would see before the end of 2013. I think Moody's probably wait to see what the outcome of the next round of bank stress tests or possibly more long-dated bond issuance from the debt management agency here, the NCMA. I think that those two things are kind of the most obvious catalysts for a Moody's upgrade back into investment grade for Irish bonds during 2014.
And finally, Philip, what are your main concerns for Ireland over the coming months as it exits its bailout programme, and what will you be closely watching?
I think for us, really, what the most important ingredient for the sustainability of Ireland's recovery is job creation, because the three main challenges facing the economy are the unemployment problem in itself, household debt, and also the public finances, household debt, and unemployment will be the three main challenges that we face. So in terms of how we address these problems, we obviously need to keep creating jobs and getting the domestic economy back, get consumer spending coming back up again, and then obviously that's something that would have a profound impact on sentiment and obviously help sustain the recovery from the sort of first steps that we have been seeing since such as the GDP data I mentioned a few minutes ago.
Thank you very much, Philip, for that. Well, viewers, do stay tuned to Dukascopy TV, as we will be keeping you up to date with the very latest economic and forex news. Goodbye for now.